this trillion-dollar question hanging over Silicon Valley right now.
Mm-hmm.
And I'm not just, throwing that number around. I mean, literally, there are trillions of dollars in market cap just sitting there. And everyone from the most seasoned Wall Street veterans to, the kid coding in a dorm room is asking the exact same thing.
Is this sustainable?
Is this AI boom actually sustainable? Is it real?
It is the ultimate bubble question.
It really is. It's the, are we buying tulips in the 17th century question all over again? We see these headlines every day. OpenAI signing these massive multi-hundred-billion-dollar deals.
They're buying chips like they're going out of style.
Exactly. Yeah. Building data centers that consume as much power as a small country. And the skeptics, they're looking at this huge capital expenditure, the CapEx, and they're just saying, there's no way.
There is no way the revenue can possibly match that spending. They're just waiting for the pop.
Waiting for the pop. And, it's a fair concern.
It is. If you look at the dot-com bust or the fiber optic bubble back in the late 90s, history is just littered with these moments where the hype completely outpaced the reality.
Right. You build the infrastructure, you lay all the cable, and then you pray the customers show up 5 years down the line.
But today, we're going to look at some numbers that they might just prove those skeptics wrong.
We are. We're looking at a very specific set of documents today, a blog post, and a really detailed financial report from Sarah Friar. She's the CFO at OpenAI.
And that's huge, because OpenAI is, they're notoriously secretive about their internal financials. They're a private company. They don't have to show us anything.
No quarterly earnings calls like Apple or Google.
None of that. But Friar has basically opened the hood, and she's looking specifically at their growth from 2023 and then projecting out into 2025.
So our mission today is pretty simple, but the stakes are incredibly high. We're going to unpack these numbers. We're going to see if the math actually works.
Right. Is OpenAI just burning cash in a furnace? Or is this some kind of calculated machine that prints money as fast as it spends it?
We're going to look at the burn rate versus the earn rate. And what we found, I think, it kind of rewrites the playbook for how we think about hypergrowth in tech.
It really does.
Okay, let's dive right in. The headline metric that Sarah Friar dropped, and is one that really stops you on your tracks when you read the report, is this concept of the 10x.
The 10x.
Right. She claims that over a 3-year period, so 2023 to 2025, OpenAI's revenue and their compute power have both grown roughly 10 times over.
And that is the core statistic. But what's so fascinating here isn't just the growth itself. I mean, companies go fast, right? Yeah. Especially startups.
Sure.
It's the relationship between those two numbers. Usually in deep tech or these big infrastructure industries, you see a huge lag. You spend billions on servers in year 1, and maybe, if you're lucky, you see the revenue spike in year 4 or 5.
It's the field of dreams model.
Yeah.
Build it and they will come eventually.
Eventually. But Friar is basically rebutting that entire narrative. She's saying that for OpenAI, the revenue growth and the compute expansion, they're moving in lockstep.
In lockstep. They're tracking each other perfectly.
Perfectly.
Okay, let's unpack lockstep, because that implies a level of efficiency that, frankly, it just seems impossible for a company this young. So let's look at the receipts. The numbers she provided are pretty wild. Let's do revenue first, just to ground us.
Okay, so let's go back to 2023. OpenAI brought in about $2 billion.
$2 billion, which, for context, is already an absurd number for a startup. Most so-called unicorns dream of hitting $100 million in revenue.
$2 billion is enterprise scale already, but then in 2024, that number hits $6 billion.
Wow, that's a 3x increase in 1 year.
In a single year. And then the projection for 2025.
What is it?
She projects it to exceed $20 billion.
Another 3x jump. So you do the math. 2023 to 2025, from $2 billion to $20 billion, that's your 10x increase in revenue.
That's it.
$20 billion. I mean, just pause on that for a second. That puts them in the league of some of the biggest legacy software companies on Earth, companies that have been around for 30, 40 years.
And OpenAI has done it in just a fraction of the time. It's dizzying.
It is. But here's where I want to play devil's advocate, or at least, channel the skeptics. Revenues are great. Top-line growth is fun to look at.
But what did it cost?
But the cost to generate that revenue is the whole controversy, right?
Yeah.
We're not talking about hiring a few more salespeople. We're talking about electricity.
We're talking about the compute. And she laid out the numbers in gigawatts. And I think for anyone listening who isn't an electrical engineer, we should probably contextualize what these numbers physically mean.
Yes, please do.
Okay. In 2023, their compute scale was 0.2 gigawatts. In 2024, it went to 0.6 gigawatts.
A triple.
And for 2025, the target is approximately 1.9 gigawatts.
Another triple. So the pattern holds.
Yeah.
Revenue triples, compute triples.
Exactly. But let's talk about that 1.9 gigawatts. That is not just a lot of computers. A typical nuclear power plant reactor. It produces about 1 gigawatt of energy.
So, wait, you're saying OpenAI effectively needs the output of 2 dedicated nuclear reactors just to keep their models running?
Just to keep the lights on, yes. That's the scale we're talking about.
That really puts it into perspective. It's industrial. This is not a server closet in San Francisco. This is grid-level power consumption.
It's absolutely industrial. And Friar's whole argument is that they're not just buying chips and electricity for fun or on speculation. They are buying them because they literally cannot process the demand without them.
So usually when we talk about bubbles, we're talking about supply exceeding demand.
Oh.
Too many houses, not enough buyers.
Too much fiber optic cable, not enough internet traffic. Precisely. That's the classic glut. But Friar's arguing this is the exact opposite. She says explicitly that if they had more compute in those years, they would have grown even faster.
Wow. So the bottleneck wasn't demand. It wasn't that people didn't want the product.
The bottleneck was that OpenAI literally couldn't plug in enough servers fast enough to answer all the questions.
It's a supply-constrained environment, not demand-constrained.
Correct. And when you have a supply constraint, spending money on infrastructure isn't a risky bet. It's necessary for survival. You can't sell the electricity if you don't build the power plant. And right now, everybody wants the electricity.
That's a crucial distinction. It kills the bubble argument if you assume the demand doesn't just evaporate tomorrow. But speaking of building power plants, or at least renting them, let's talk about how they're actually doing this. Because the report mentions a major strategic shift that I think went under the radar for a lot of people.
You're talking about the pivot in their infrastructure strategy.
Yeah. For the longest time, it felt like OpenAI and Microsoft were practically the same company. They were married. You couldn't say OpenAI without saying Azure.
It was a very tight, exclusive partnership. They were certainly monogamous.
Right. But reading this report,
Yeah.
it sounds like they've decided to see other people.
That is a very apt way to put it. In 2023 and 2024, OpenAI was almost completely reliant on Microsoft for all that compute. But Friar's report highlights a big move toward a multi-vendor model.
So who are the new partners in this open relationship?
It's a who's who of Silicon Valley hardware. You've got Nvidia, obviously they're going direct now, but also AMD, Oracle, and even some smaller, more specialized players.
Why do that, though? I mean, if Microsoft has the deepest pockets in the world and the integration is already there, why complicate it? Is it just about getting better prices?
Pricing is definitely part of it. Competition always helps. But it's really about two bigger things: control and risk management.
Okay.
When you're tied to a single vendor, your entire roadmap is dependent on their roadmap. If Azure has a delay building a data center, OpenAI has a delay. Friar says that moving to multiple vendors gives them much better control over their own destiny.
So they're not waiting in line anymore.
They're not waiting in line. And the second reason is financing. Different partners offer different ways to structure deals. It allows OpenAI to not be entirely beholden to one company's balance sheet. It's a sign of corporate maturity. You don't want a single point of failure for your most critical resource.
It's growing up. It's moving from being a project inside a giant to being its own sovereign entity.
Yeah.
But there's a technical detail here about the chips themselves that I found really interesting. It's not just about buying more chips. The report suggests they're changing what kind of chips they buy.
Yes, the tiering system. And this is so critical for understanding how they get to profitability.
So it's like economy class versus first class for chips.
In a way, yeah. Think about it. Not every query to ChatGPT needs the same amount of horsepower.
True. If I'm asking for a pancake recipe, I probably don't need a supercomputer.
Exactly. You don't need a PhD to flip burgers, and you don't need a brand new H100 GPU to write a pancake recipe. But if you are training GPT-5 or whatever comes next, you need the absolute best, fastest, most expensive hardware on the planet.
That's the Rolls-Royce tier.
That's the Rolls-Royce tier, the cutting-edge Nvidia stuff. Friar explains they reserve that for training and for the hardest reasoning tasks.
And what about it for the pancakes?
For the pancakes, or what they call high concurrency inference, which is just fancy talk for lots of people asking simple questions at once, they're using an economy tier.
Cheaper hardware.
Lower cost, highly efficient hardware that is good enough for just running the model, even if it could never train it.
That makes so much sense. You don't take a Ferrari to the grocery store.
And this is where that multi-vendor strategy really shines. She mentioned a specific partnership with a company called Cerebras.
Oh, I saw that name. Cerebras.
Yeah.
They're the ones with those enormous wafer-scale chips, right?
They are. And just to explain that quickly, usually a chip is a tiny square cut from a big silicon wafer. You get hundreds of chips from one wafer.
Okay.
Cerebras makes a single chip that is the entire wafer. It's the size of a dinner plate.
And what's the advantage of a chip the size of a dinner plate?
Speed. Incredible speed. Because all the memory and all the processing are on one giant piece of silicon, data doesn't have to travel between different chips over slow wires. And OpenAI is using Cerebras specifically for their codex model, the one that writes code.
Because when I'm coding, I want that autocomplete to be instant. I can't stand waiting for the cursor to blink. You need low latency.
Exactly. Cerebras allows for ultra-high-speed inference. So for coding, where you need that instant response, they use Cerebras. For heavy reasoning, they use Nvidia. It's the right tool for the right job approach.
It sounds like they are ruthlessly optimizing their margins, not just spending blindly, but spending architecturally. Which brings us back to the money. The $20 billion.
A big number.
Where is that actually coming from? Because that's a lot of $20 a month subscriptions. Is it all just ChatGPT Plus users like you and me?
That's a big chunk of it for sure, but Friar outlines 3 distinct pillars of revenue, and the diversification here is really key.
Okay, let's break them down. Pillar number 1.
Subscriptions. That's the consumer side. You paying for ChatGPT Plus, companies paying for team accounts. That's the bread and butter.
Got it. Pillar 2.
Developers. The API service. Companies building their own apps on top of GPT-4. Every time an app makes a call to the API, the meter is running.
Okay, so that's the standard software as a service model. Pretty standard stuff. What's pillar 3? Because this is the one that really raised my eyebrows.
This is the one that might surprise people, and frankly, it might annoy some people. It's the free users.
Wait, how do you make money from free users? I thought free users were just a cost center. They burn your compute, they don't pay the bill.
Not anymore. Friar explicitly lists ads and e-commerce from free users as a major revenue pillar.
Ads inside ChatGPT.
Yeah.
I feel like that goes against the whole ethos of the clean, helpful assistant. Are we going to start seeing pop-ups?
I doubt we'll see pop-ups. It seems like the direction is more integrated e-commerce. Think about it. You ask ChatGPT for gift ideas for your dad who likes to golf, and it suggests a specific pair of noise-canceling headphones.
And right there is a massive opportunity for affiliate revenue. Or sponsored placement. You're the top 5 headphones, and the top one just happens to be from a partner.
That's it. It changes the vibe from a pure utility to a media platform. And it taps into a market that, Google has completely dominated for 20 years. If OpenAI can monetize the intent of the user, that's a huge revenue stream.
It's lucrative, but it's a slippery slope. Once you introduce ads, the incentive can shift from giving the best answer to keeping the user on the platform.
That is the tension. But Friar's view seems to be that it's necessary to subsidize the cost of that economy to your compute. You can't offer a free service that runs on nuclear reactors without some way to pay for it.
Fair point. Okay, so subscriptions, developers, and the ad model. But she didn't stop there. She talked about the future of pricing. She mentioned something called outcome-based pricing.
Yes. And this is a potential game changer for the entire software industry. It's a fundamental shift.
Explain that. Right now, we pay for access. I pay my $20, I get access. Or a developer pays for tokens, basically paying by the word.
Right. That's input-based pricing. You're paying for the effort the machine makes. It's like paying a lawyer by the hour. You pay for the time, whether they win the case or not.
And outcome-based pricing flips that on its head.
Completely. You don't pay for the input, you pay for the result.
So if I ask it to write code for a website, I don't pay for the tokens it generated. I pay for the working website.
Theoretically, yes. Or imagine a sales agent AI. You don't pay for the minutes it spends talking. You pay a commission when it actually closes a sale.
Wow. That shifts the risk entirely from me, the buyer, to OpenAI.
It does. It puts the burden of quality squarely on them. If the model hallucinates or fails, you don't pay. But if it succeeds, the value of that outcome is much, much higher than the cost of the electricity it used.
It's almost like hiring an employee on commission rather than just renting a piece of software.
That is exactly the comparison. She also mentioned revenue from IP licensing, but that outcome-based model is the one that signals a shift in what AI actually is. It stops being a tool and starts becoming an agent.
Okay, so putting this all together, we have the 10x growth, the 1.9 gigawatt power grid, the multi-vendor strategy, Sarah Friar has a name for this whole machine, right? She calls it the virtuous cycle.
She calls it the economic feedback loop, or a virtuous cycle of intelligence, and she breaks it down into 4 simple steps. This is the engine of the company.
Okay, walk us through the engine. How does it work?
Step 1 is infrastructure, the chips and the power. That determines your delivery capability. If you don't have it, you can't even play the game.
Step 1, the hardware. Got it.
Step 2 is innovation. The infrastructure lets you train better models, GPT-5, GPT-6. This sets the ceiling for how smart your AI can be.
Better hardware, smarter AI.
Okay.
Step 3, user adoption. The smarter the AI gets, the more useful it is, so more people use it. That determines your scope of influence.
And step 4 is the money. Step 4 is revenue. The users generate the cash. And this is the critical part. That revenue provides the funding for the next stage of infrastructure.
And the loop starts all over again.
But bigger. Much, much bigger. Each time the loop completes, the scale it ratchets up.
So the $20 billion in 2025, that isn't profit to be paid out as dividends. It's fuel.
It is 100% fuel. Friar isn't describing a business plan where you reach some stable plateau and just coast. She's describing this as becoming a global economic foundation. The revenue exists for one reason, to fund the next jump in intelligence.
It sounds like they're trying to build a utility. Like electricity or the internet itself. You don't finish building the power grid, you just keep expanding it.
A utility for intelligence, that's the ambition. And when you look at that 1.9 gigawatts, that's not software scale anymore, that's industrial scale.
It really reframes that whole burn rate conversation we started with. They're not burning money, they're converting money into intelligence infrastructure.
And as long as the demand keeps tripling alongside the spending, the cycle holds. The danger, of course, is if that demand flatlines.
Right.
If people suddenly decide AI isn't that useful, you're left holding a massive bill for 2 gigawatts of power and no one to pay for it.
A very, very expensive paperweight.
The world's most expensive paperweight.
Right.
But according to her data, there's just no sign of that happening yet.
So we came into this asking if it was a bubble. And looking at the 10x lockstep growth, the multi-vendor strategy, the new revenue streams, it looks a lot more like a rocket ship than a bubble.
A rocket ship that is consuming a significant percentage of the world's computing power as fuel.
Just a small detail.
Just a minor detail to keep in mind.
We've covered a massive amount of ground today. We unpacked Sarah Friar's report, that 10x growth in revenue and compute from 2023 to 2025.
We looked at the massive infrastructure expansion to 1.9 gigawatts and the strategic break from relying solely on Microsoft.
And we looked at how they're paying for it all, subscriptions, developers, and that controversial move into ads.
It's a comprehensive look at the business of building intelligence.
Now, before we let you go, I want to leave you with one final thought. And it goes back to that concept we touched on earlier, outcome-based pricing.
It's a fascinating concept.
It really is. I want you, the listener, to just think for a second about what that means for your relationship with technology. Right now, if you use a search engine and it gives you a bad link, you blame yourself for not searching better. Or you just click the next link.
Right. It's buyer beware. You didn't pay for that specific result, so you don't feel cheated.
Exactly. But if we move to a world where we stop paying for access and start paying for results, does that fundamentally change the responsibility of the AI? If you were paying OpenAI specifically to write a working legal contract, and that contract has a loophole, who's liable?
If the product is the outcome, then the liability for that outcome has to shift to the creator. You can't sue Google for a bad search result, but you can absolutely sue a lawyer for malpractice.
That's it. If the AI gets the answer wrong, do you still pay? And if you don't, does the AI company just stop offering to answer difficult questions to protect its margins? This shift might sound like just a billing change, but it could redefine the entire economy of software. It turns software from a tool you use into a service you trust to be right.
And that is a very, very expensive promise to keep.
It certainly is something to chew on. Thanks for diving in with us today.
Always a pleasure.